Hey, it's Jack from the Online Real Estate Academy and Jack Gately Real Estate. Wow, what a change in the whole economic outlook since, say, like last Tuesday when I issued the monthly market report. So I wanted to come into you and talk with you today about what's changed and how this whole bank failure thing might impact the housing market. Let's get into it. So just last week, last Tuesday, Fed Chair Powell, as this CNBC headline says, Fed Chair Powell says interest rates are likely to be higher than previously anticipated. That was just Tuesday. And by the way, this update's not going to be super long, just going to be a quick update. Plus, also, I'm not a financial advisor. Don't take financial advice from me. All right, so this was just last Tuesday. Expect higher rates for a longer period of time. But whoa, how 6 days have changed. Take a look at this. This is a chart of 10-year treasuries. Oh, Jack, don't get so confusing. Well, 10-year treasury bills usually predict the mortgage market for your basic vanilla mortgage like the 30-year fixed and all the other mortgages too, but especially the 30-year fixed. And as you can see in this 10-year treasury chart, we were kind of peaking in very early March. That's when mortgage rates just peaked a little bit more than 7, and then they came down a little bit, and then, whoa, last week, they've slid a lot. In fact, they've actually slid even more this morning if we were to actually just go intraday on this chart here. I don't know if that will load. So that means that if 10-year treasuries are sliding lower, that means that mortgage rates are highly going to slide lower. And here's an article from the Financial Times in London, just published this morning. Let me put my face over here. Here we go. SVB collapse forces rethink on interest rates and hits bank stocks. Now, let me explain why that is. The big problem with Silicon Valley Bank and some of these other banks is that there's a huge differential between the bonds that they bought, say like in 2020, 2021, even early 2022, and what interest rates are now. So it's just not an effective place to put your money. If a bank is going to pay you 1.5%, why would you take that when you can invest it elsewhere and get like 4.5 or more percent? Like you can make triple the return someplace else. So why would you invest in Silicon Valley Bank? Why would you keep your deposit there? You wouldn't. So raising interest rates again later this month at the Fed meeting, which I believe is on the 21st, 22nd, would only exacerbate that rate differential and make the especially regional banks, and all banks generally speaking, but especially regional banks, more susceptible to failure. But every action has a reaction, and if you don't raise rates, then basically you're saying, oh, inflation, go do whatever you want. Inflation go up, I guess we're just going to ignore that for now. Plus, there's the credibility issue. If the Fed last week said we're going to, how can they just like a week later totally change their mind? Right? Like if last week you said interest rates were going to go higher for longer and now you're not going to raise them at all, when do you even know what you're doing? Like there's a big credibility gap there. Now tomorrow, Tuesday, which is the 14th, the consumer price index, or basically the inflation number, is going to come out. And that's kind of been the other shoe that a lot of people have been looking for. We have the jobs number, and now we'll have the inflation number tomorrow at 8:30 a.m. Tuesday. And then we'll have the next big event after that will effectively be the Fed meeting later this month, in about a week or so from now, 10 days from now. So buckle up. It's going to be a bumpy ride. What does this mean for the housing market? Well, it's not an immediate thing, but it's something that you want to keep an eye on. As interest rates have gone up, prices have gone down. Generally speaking, there's a high correlation against high interest rates and prices, or inverse correlation, I should say. So if we're not going to raise interest rates anymore, then prices might stabilize and might start to actually go up. So this is why. That's the big connection. As interest rates go up, prices have been going down. There's an inverse relationship. So we have to keep a very close eye on this. It's a very interesting time to be alive and to watch this. So stay tuned. I'm John F. Gately. Jack, you can call me Jack. We're friends by now, right? You can call me Jack. It's actually on the sign. It's on the sign over here somewhere. You can call me Jack from Jack Gately Real Estate and the Online Real Estate Academy. Have a great day.